An interesting week ahead. Certainly, it's a busy one for the UK in particular. A raft of data points coming out over the course of the week. That's going to be the focus of today's video, most notably the inflation report coming out on Wednesday. Also have jobs on Tuesday, the PMIs on Thursday, and the retail sales numbers coming on Friday. So plenty for us to sink our teeth into at a time where certainly there's been a big focus on the UK economy, given everything that's happening in Iran, the potential shortages in terms of jet fuel in particular that could be coming Europe and the UK's way, and the question marks around whether the Bank of England is going to raise rates on already relatively lofty interest rates. So all that and more, let's get into exactly what this inflation report in particular could mean for the likes of the FTSE 100 and cable. So first and foremost, let's just jump onto the outlook for the week ahead as a whole in terms of the UK data. Remember, the jobs report on Tuesday is for February, and right now it sort of feels like we want to see up-to-date data that tells us exactly what the state of play is, given everything that's happening in Iran. So whilst it will be notable if we see a deterioration in terms of the UK jobs market, if it comes in strong, let's say a decline in terms of unemployment or something like that, markets are by and large probably going to ignore that because they know that there are some relatively troubling times ahead. Then we've got the Wednesday data coming out. That's where I think the main port of call will be, because inflation, of course, is the key thing that drives interest rates from the central banks and interest rates in terms of bond yields anyway. And you can see here there's a perception that we see a headline number of 0.8 for the month, up from 0.4 last time, which was relatively lofty in February anyway, prior to the crisis, and now inflation up to 3.4%. Remember, I've spent the best part of a year talking about the idea that within March, April time, we're going to see a major disinflation, in particular April, as base effects kick in. Well, it looks like that's pretty much going to get wiped out because of what's happening in Iran. So thanks to Donald Trump, doesn't look like we're going to see any rate cuts. For the time being, the question mark for many is, are we going to see rate hikes? Notably, we also have input and output prices for factories. So certainly that will give us an idea of how businesses are faring and the conditions with regards to input prices, i.e. fuel, output prices, i.e. what they're charging to consumers or to other businesses. And so certainly I think the PPIs are going to be notable. And then we look at the PMI numbers. That's significant because they are for April. And you can see here the expectation is, in actual fact, they strengthen. So that's a key one to be watching out for. With regards to the retail sales numbers, we can, of course, look out for that from a viewpoint of fuel to see if people are seeing a significant rise in terms of fuel purchases and the value of that, and whether that's then having a knock-on implication in terms of their willingness to spend on other things. Of course, it's almost like by raising the cost of fuel, it can gobble up the amount of disposable income someone has to be able to spend on other things in the economy. So first and foremost, we come off the back of an IMF report that essentially saw downgrades across the board when it comes to growth and upgrades in terms of inflation, exactly what we don't want, because of course the dreaded word stagflation comes into play. Now, notably, the big story around this was for the UK. As you can see here, the downgrades hitting the UK more than most. Who's doing the best out of the move? Well, it's Russia, of course, because they see an upgrade in terms of the value of their exports. In actual fact, we've actually seen some of the sanctions taken off by Donald Trump. So yeah, the UK, as you can see here, there's a perception the UK is going to be hit harder than any of the other developed nations, given what's happening in Iran. In terms of the UK inflation picture, as you can see here, you cast your mind back to a year ago, and the sort of February, March, April time saw relatively lofty readings in terms of the monthly CPI numbers. And that's why we thought come May time, when we see the April number, that was going to see significant disinflation, driving us, as you see at the bottom here, below 2%. Well, where are we at the moment? Well, we're at 3 and 3.2% for headline and core respectively. But the perception is that we're going to go higher. Now, notably, we could see disinflation coming into play in April if we do see a monthly reading of, I don't know, let's say 0.8 if we see it this time around, but not to the same degree as we thought we were going to see previously. And if we see a 0.8 reading this time, as markets are expecting, then that alongside the April reading means that we're certainly not going to get anywhere near that 2% target. And so then it comes down to the Bank of England. Are they willing to look through this inflation shock? I don't necessarily think they would, quite frankly. And certainly, you know, where you've got that dual mandate for the Federal Reserve, the Bank of England will have a greater focus on inflation, and it's likely to be a greater inflation shock in Europe than it is for the US, which is relatively self-sufficient. And in particular, going to see the shortages that you wouldn't see in the US. So inflation is expected to go higher from here. Of course, if it comes in heavier than expected, or hotter than expected, then we're likely to see a significant move. If it comes in cooler than expected, like the Canadian readings just come out, 0.9 for the month rather than 1.1, it's not like everyone's going to think, okay, everything's fine, because they know that the next month could see another 0.9 and another one the month after that, until we see a resolution and prices calm down. So certainly it's sort of skewed in one direction rather than the other, so to speak. As you can see here, the latest, in actual fact, the CPI numbers just come out, so for Canada, so that's not actually been updated here. But what's notable is you can see here that there has been in February a rise in terms of inflation, and then that's really taken off in March. So the reflation move is certainly a significant story that's playing out at the moment, a significant narrative. And what's interesting is that it doesn't necessarily just mean that, say, okay, we see high inflation for the pound, for the UK, that means the pound's going to strengthen. Well, against the US dollar, not necessarily always the case. In terms of the jobs market, we can see we've seen some deterioration, so higher unemployment, higher claimant count coming into play. And like I said, the report is for February, so it's not necessarily something I think markets will care about too much. If we saw it holding strong, then maybe people think that the UK economy is strong enough to withstand higher rates. It could maybe view it from that perspective. But if we saw a rise in terms of, say, unemployment, I don't necessarily think that we're going to see a perception that the Bank of England is going to suddenly start cutting rates, or going to be much more dovish, quite frankly. It's more of a continuation of that trend. Then we'll look on in terms of the market as a whole, in terms of rates expectations, inflation expectations, the perception of what that would do for markets. So we can see here the relationship between the 1 year, the 5 year, and the 10-year yield, alongside the FTSE 100, which is inverted in purple, and cable. And what you can see here is that we've got that inverse relationship between the FTSE 100 and cable. And so essentially, if we see lower interest rates or lower bond yields, that by and large hasn't necessarily boosted cable. It has weakened it. And the main reason for that is that really people are reacting more towards the US dollar in terms of this move than the other currencies out there. And so if there's an expectation that we're going to see higher inflation, and therefore we see higher bond yields coming into play, that benefits the US dollar more so than these other currencies. What will be notable here is, of course, if we do see high inflation for the UK in particular, then that's not reacting to the wider dynamic that's playing out. So if we see a news headline that is around a breakdown in relationships between the US and Iran, an extension of the war, and therefore people think inflation will be higher for longer, that has by and large helped the US dollar, despite the fact that it also raises bond yields in, say, the UK, which in the past might have benefited the pound if it's relatively higher compared to the rise in terms of, say, US yields. And so if we do see bond yields in the UK rising at a time where we don't necessarily see it for the other markets, i.e. around the release of, say, CPI data that comes in particularly hot, maybe that does provide a boost for the pound against the US dollar, but probably more so some of the other currencies out there. Now, in terms of the market reaction for the FTSE 100, it's doing well at times where bond yields are coming down because people are less fearful around the war. And it's doing poorly at times when bond yields are on the rise because people are fearful around the rise in inflation and the lengthening of the crisis. And so really much of this is a play around what's happening in Iran. Of course, if we see the inflation data coming in very hot, then we would expect to see upside in terms of bond yields, weakness in terms of the FTSE 100, and weakness in terms of the pound. So in terms of market expectations, we can see here the Bank of England rate expectations pointing towards a potential hike later on in the year. You can see it's the base case scenario for July at 57%. And, you know, some are even calling for a second hike by the end of, or by midway point of 2027. In actual fact, earlier than that, but really roughly it's sort of 30%. And that sort of kicks in something like November, December. So really markets at the moment think there's a good chance we see a rate hike coming into fruition. A lot of that's going to come down to how the Iran crisis plays out and also how inflation comes out. So if inflation comes in really hot, we see a sharp rise, then you're going to see a growth in terms of those numbers attributed to rate hikes. That could put pressure on the FTSE 100 and potentially strengthen the pound, in particular against other currencies, but to a degree against the US dollar, if it's coming off the back of UK data rather than developments on the Iran front. So let's jump onto the charts quickly to wrap this up. And we can see here, first and foremost, here is the chart for cable. And like you can see here, by and large, we're seeing kind of an inverse relationship where you might in the past have seen a positive relationship. So that is in relation to the UK 2-year, even the 2-year relative to the US 2-year. At the moment, they're inverse to what's happening in terms of cable. And that really alludes to the idea that if we see higher inflation expectations coming off the back of the war, that's benefiting the US, even if bond yields are rising to a greater degree. So really, when it comes to Iran, greater fears, the risk off move, all that, higher inflation expectations, that's benefiting the US dollar rather than the pound. In terms of price action, you can see we've been seeing these significant swings. Most recently, we've seen that strengthening of the pound. That's come around the idea that we could be in the final innings of this US-Iran issue. So if we see that sort of heighten and we see the breakdown of relations once again, then you've got a potential problem on your hands. And therefore, we'd see this rolling over. But as long as we're moving towards a potential deal, then it's likely we're going to see further upside for the pound. If we do see the UK data coming out particularly strong in terms of inflation, that could once again give us that leg higher that at the moment looks like it's coming into fruition because we're seeing that sort of rally, consolidation, rally, pullback, consolidation. So the potential for further upside, particularly if we do see that strong inflation read coming out. In terms of the FTSE 100, we've been regaining ground to the extent that we're very close to the prior peaks that we saw pre-war. Very significant, people feeling more confident here. You can see this consolidation playing out. If we do see a sharp rise in terms of UK inflation, that could hamper sentiment for the time being. But as long as we don't break down through your swing low of 10333, then the bulls still remain in charge as things stand for a potential rally from here. And you can see this pattern on the hourly time frame probably clearer, the creation of lower highs and lower lows starting to gradually turn towards a more bullish setup. So over the near term, you can see this sort of retracement coming into the fold here, that deep retracement here, signaling the potential for the bull to come back into play. But really, a lot of this really comes down to what's happening in Iran. If we see a breakthrough, then great, and we see negotiations continue, an extension of the ceasefire, then perfect. If we don't, then you're likely to see the FTSE 100 here. But trading around that CPI report, of course, if we see a sharp rise in terms of inflation higher than expected, then it's the kind of thing that could hamper trading around the FTSE 100. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name's Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.